Hey guys, Mike here. So about what a day yesterday, and it's funny because my thumbnail for Thursday night video was going to be welcome to Trump's market, because when he tweets and everything about tariffs, boom, market drops, and the same thing happened Friday, yesterday. Comes out saying it's still going to be enacted as of, I'm recording this on Friday, so it'd be Saturday as you're watching this, and we'll see if that's the case or not. But obviously, one of the questions you guys was talking about was tariffs and prices and inflation and stuff. So we're going to talk about that in this video, and we'll see if he goes through with it. And no, it is not good for consumers if he does. And so again, we'll get into all that. You have some really good questions this week, and I really appreciate it. Did a lot of research. Feel free to participate on this. And I didn't do that thumbnail because it tends to trigger a lot of people, and I just didn't feel like dealing with the comments. But that's kind of where we're at now. You may be in a position, and hopefully things go your way. I know somebody said they had puts on Thursday when that announcement came out of tariffs, and so they raked in. But I know a lot of people had called, and they were not happy at that time. So we'll see how the rest of the year shakes out with this. I'll be glad when it's all over and we just enact them or don't enact them and be done with it, so we can move on with life. That would be nice, instead of waiting on a freaking statement to drop the market at 1% in less than a few minutes. You know what I'm saying? So anyway, here's the first question. It says rates was going up and dollar was going up since October. Market was going up as well. Also, interest rates going down will scare everyone because recession is near. That's actually not true, but I will show you this right here. When you look at this, it really depends on the level the 10-year is at, okay? And there's a little shaded area right there in the middle. That's around the 4% mark. Something about that right there creates magic in the market. It really puts fear in the market when we get above 4%. Market loves it when we get below it. Okay, how do I know that? I'm going to pull up certain things. And it's not the market. The SPY usually goes up regardless, right? And especially the Mag 7. They don't really care about this. But it's the smaller companies, mid-cap companies, other things and sectors that absolutely hate it when the 10-year yield rises, because it's loan rates. Look at XHB, home builders. You know, look at this, going crazy when the 10-year was falling, especially when it got below 4%. But look what happened when it come down here and broke 4%. See ya. And then when it came back down, retested 4% again and bounced. Look at that drop. Boom, fell off a cliff, especially when it gets near 5. Freaks the market out big time, okay? And then you come over to another one. You got IWM. We already talked about this a million times, so I don't cover it, you know, that much. But you can see, I mean, right here was a Trump thing, right? Trump gets voted in somewhere in this area right here, and that's when all these quantum computing stocks and everything else is going crazy. But when reality sets in, it's an inverse relationship, especially over 4%. It tested that 4%, went up. IWM dropped like crazy right there, as you can see. And then the 10-year started coming down, and what I tell you, IWM started ripping, right? Because small caps have to take on a lot of debt to stay open, and if loan rates are that high, well, it's not good, right? And so another one you can look at here is like XLI, and I'm just taking some for example. Again, industrials. You can see it's basically once you up to 4 seems to be okay. Boy, once it gets past 4, you see how industrial went, can't do this anymore. And then all of a sudden it drops off a cliff, and industrials goes crazy right there. See that right there? When it drops below 4, then it comes back up. Gets over 4, industrial's like, then it comes back down, retest, and look at that drop. As soon as the 10-year started running, baby, industrials went, see you later. And then when the 10-year started to sell off, industrials all of a sudden came back like nobody's business. But no, it has a drop in 10-year doesn't mean people are like, oh my God, it's recession. Right now, what happened with the 10-year was it started pumping up because when the Fed started cutting, the bond market's like, what are you cutting for? You don't have inflation under control, and not to mention you're issuing a ton of debt for this deficit. So we need more yield for our buck here, okay? And so again, if this starts to drop back down, then you're going to see certain things run. That's what we've seen so far. So we'll see how the 10-year is going to act or not. But no, the 10-year, it comes down all the time, and the market don't go into recession. We've had very few recessions. So no, that's not true at all. Hope that helps. Now, next one here for next Saturday, can you talk a bit about the relationship between funds, for example? This ties into the first one, so I'm not going to go in detail on this. But like TLT goes up and the 10-year goes down, all this fun stuff. I'll actually give you another one. Let's talk about the dollar for a second, because I just showed you the 10-year. The dollar, emerging markets, baby, inverse relationship here. When the dollar gets weak, emerging markets love it, and you can see it clearly on that. That is an inverse relationship. Dollar's going down, emerging markets going up, dollar's getting stronger, emerging markets go down. Same thing. You see it right there? So emerging markets, so if the dollar starts to weaken, which some people think it will, you can see it starting to roll over a little bit, and what emerging market do? They're starting to come back up. So if the dollar does weaken, then you're going to see emerging market stocks or money starting to roll into those areas. Also, if the dollar weakens, it does help like the Mag 7, all these companies bringing money back in to report on their earnings. Okay, so that does help as well. So just putting that out there to you, hope it helps. Next one here, what do you mean about dividing an ETF by the SPY? I've never heard of doing that. I agree with comparing ETF to the SPY, but dividing it by the SPY, please explain. You can literally just put the ETF symbol in, put a division symbol in, and then hit SPY, right? And put SPY in. And there you go. I have a whole sector folder for this right here. And I do every one of them to see how they're performing against the SPY, because if they're not outperforming the SPY, there's no point in me being in them, right? And not too many sectors outperform the SPY on a regular year-over-year basis. And you can see right here, if it's going down, it's not outperforming the SPY. If it's going sideways, it's holding its own. If it's going up, it's outperforming the SPY. All right, and that's why you've seen like utility, for example, have definitely been outperforming the SPY. And so we'll kind of go into detail on this. Like, for example, XLP. You see right there, I'm going to give it its best time. You look to the left, usually it doesn't perform that great. But here, 28%, right, in that 350-day window. And then we'll go over to the SPY, and we'll measure the exact same thing. And you go, okay, well, cool. Well, did it outperform the SPY in that 350-day window? No, right? So what's the point? Even though it looked like it was going crazy, it didn't outperform the SPY. Right there, as you can see, the SPY outperformed it, okay? If we come back over and start looking at some of these, you'll see not too many do. We start just scrolling down again. You see most of them trending down against the SPY, okay? Because, I mean, the SPY on average would crash is 8%, but you saw in the last couple of years, it's returned like 20 to 30%, right? Jets here, for example, prime example. This one got crazy. You see this move right here? What is it, 40% basically in 2024. Now, if you compare that to the SPY, we'll go 2024. Well, guess what? Jets outperformed it. So actually over like 14% it outperformed it. So that one was good to be in, right? But when you pull out, and again, this is Jets versus SPY, so if it's going up, it's outperforming. So it's on a sharp V right there. But you look to the left, you can see clearly it's in this long downtrend, right? And normally if you go to Jets, no, this is not outperformed the SPY. You can see like 2 straight years it going down, then it's going sideways. You just had this crazy move right here happen in 2024. Let me adjust this. As you can see, normally, not a chance this is outperforming the SPY. And so, again, everybody likes to be stock pickers and ETF pickers, but unless you're getting a hefty dividend for this, then maybe it makes sense. Okay, you're trying to get passive income, that kind of stuff. There's only a few that do it, and the ones that really outperform it, I bet you already know, honestly, is this right here, the Mag 7, right? The big boys. And so Mag is a new ETF. I just put it in there to kind of track that. But it's one of them. Utilities has been doing really well. You can see, because every once in a while you see this big move, right, where utilities outperforming the SPY, especially during rough times, because usually people roll into utilities, healthcare, that kind of stuff. XLK does very well against the SPY, obviously, as your big mega cap stocks and everything, so they aren't really so affected by the 10-year yield and all this other stuff. But again, you go back to Mag 7, you can clearly see right here, I mean, 75% in the year of 2024. Well, we know what SPY was, right? So that's really what I'm talking about when I'm saying you got to compare stuff to the SPY, because and you can do this with individual stocks, obviously. And so again, but just ETFs, like, why not be in BOO or whatever it is that tracks the SPY and everything like that, versus trying to be in these other ETFs, even with dividends, don't outperform it. Just doesn't make a whole lot of sense to me. Maybe I'm missing something. So hopefully that helps you right there. Next one here says, hey, Mike, can you give an update on the housing market? I haven't heard you talk about it in a while, and so many people are calling for prices to crash now. I don't know about the prices crashing, but again, that's different in every region. But the housing market's a mess, right? I mean, a growing share of home listings are lingering on the market. No crap. Why? Because the freaking prices are sky high, for crying out loud. You can see it. I see it in my own neighborhood where people have had them on for a long time when they were coming off so fast, right? And all of a sudden it's like, wait a minute, what happened? Because rates went back up. And look at this right here. This came out like a week ago. Home prices rise in all major metros for the first time since 2022. So all those 50 big and large metro areas, the houses prices actually rose. You know, and when you look at this stat right here, it's very misleading. Percentage of mortgage-free U.S. homeowners, 40%. Why do you think that is? 2 reasons. One, a lot of baby boomers have retired. They got no house payments. The other one is less buyers are coming in. So it's throwing off the equation. That's why. Okay? That's why it's that way. If we have more home buyers come in, I'd be willing to bet it wouldn't be where it's at right now. But you look at just the data that came out this past couple weeks. December pending home sales, minus 5.5%. Look where it's at compared to where it was. Look at that. So pending home sales, because nobody who lives in their house right now is selling, which I'll talk about that more in just a minute, for a very good reason. Look at December existing home sales. Yeah, I mean, these right here, falling off a cliff, right? Look at where it is in the bottom right-hand corner. Look where it was, norm, okay? And then you look over here, new home sales. Well, look at that. That's actually higher than what it used to be. When you're talking about, this goes back to 2010. You're like, okay, that's where it was. Well, we're there. Look normal. Why? Because that's the only thing people can really buy is these new ones, right? And so why is that? Well, look at the freaking mortgage rates. Look at this, 7%. You have to go back to where I bought my first home in the mid-2000s. That was normal. Like, people don't realize that was normal, all right? And then you look at how low they got in 2020, 2021. And I don't know, what's funny is I was sitting in my home office putting together a video for you guys. A guy calls me from a mortgage company, supposedly, says, hey, how would you like to refinance into a 2.3% mortgage? And I said, yeah, no thanks. Click, hung up because I thought it was a joke. I thought, not a joke, I thought he was a scammer. I thought he was trying to steal my identity and get my social, right? Because I never heard anything like that before. Now you know why. I never thought they would get that low. And then, of course, then I was like, wait a minute. Went online, holy cow, called the person back, said, I would love to. So I'm sitting in a 2.3% mortgage, putting the bottom what you're sitting in. And so I tell my wife, if we're going to stay in the same area, there's no point in even trying to sell, because now the mortgage rates will be almost 3 times what we have now. And the houses are going for like 1.7, almost twice as much as what we actually bought ours for originally back in like 2016, 17, right? So it just doesn't make any sense at all. And so, again, though, that's what's helping hold the stock market up too, because people aren't putting these huge down payments on houses. They, are sitting here going, well, the money got to go somewhere. Why? Where's it going? Getting invested. That's where it's either going into money markets, going into the stock market, it's going somewhere. It's going to Vanguard, it's going to Fidelity, right? And they're buying stuff for you. So it's going somewhere. And so that's the deal with that. And again, I don't know how you fix the housing market where you put it back to normal without a recession. I don't understand how you would do that, but that's just me. Now, next one here from George says, can't the Fed buy long-term treasuries, inflate their balance sheet even more? Oh, absolutely. And so the key is, though, they can't buy new debt. They can only buy existing debt on the market, okay? And so that's a key thing to understand. But what I've always said, I've been saying it for like 2 or 3 years now, look at every single crisis we hit. What do Americans do? We don't question anything the government does, and every single time they one up what they did before. Remember when they were buying car companies in '08, for crying out loud? Never done that before. Picking winners and losers, right? And I guarantee your family business wasn't one of the winners they picked, all right? They left you out in the cold. 2020 hits, and they're like, oh, cool. We'll buy ETFs, we'll buy corporate debt, right? All kinds of stuff. We'll just buy whatever's moving, And we just say and go, whatever you got to do to save our 401ks and IRAs and investments. That's what we do, right? What are they going to do in the next crisis? What are they going to do? They've already bought everything else. What else? What do you think they're going to buy next? That's the question. I mean, it's an amazing thing, boy, how much stronger and powerful the Fed and the government has gotten in this country. And we just sit here and go, cool, sounds good. But we'll pay the price. I mean, I don't think we will, but most likely our kids will, for sure. No doubt about that. Mark my words. History does repeat. Now, next one here says, just selling naked puts and calls is dangerous, isn't it? Can you cover examples of how you can blow up your account? And absolutely. In the first, like I said, you never sell a cover call on a stock you're not willing to lose. And you never sell a cash script put on a stock you're not willing to own. You got to want to own it. And so the biggest way to blow it up, I guess you want to say blow up your account, is if you're selling, let's say Nvidia's at, 130, I'm going to make this up for you. You say, well, I'm cool on at 120, so I'll sell a cash secure put, which will put me in at 120. And all of a sudden, some news like the other day comes out, and Nvidia just tanks, right? And it just keeps tanking. Well, you're going to get a sign, and then all of a sudden, you're going to be down the shares. And the question is, you're going to hold them. And then if it keeps going down, right, and just never recovers, that's how you blow up your account. Okay, that's really the big thing. That's why you don't really do it on stocks that can get blown up. Nvidia's not one of those, but I mean like half-line type stuff. But, that's a big one. As far as like doing the the cover calls, you're just going to lose your shares. So you got to make sure you're willing to lose them, and also be very careful doing this around earnings. Earnings, you get those big moves. And I mean, imagine Nike, for example. Imagine if you sold a cash script put on Nike way back, like, was it 2 years ago before it started to tank, because it's been tanking so long. And you saw those big drops on earnings, and you kept holding and you kept DCing in after you got a sign, right? Well, that's one way to kill an account. Okay, so you got to be careful. It's not just doing it blindly and stuff. So hopefully that's a good enough example for you. Next one here says, regarding the 3% inflation rate, it's important to note that it may not accurately reflect the true cost increases you're experiencing in your area. In our Midwestern city, real price inflation seems closer to 20%. Do you foresee a reduction in costs for essentials like food, gasoline, or insurance in the near future? We've significantly cut our spending and plan to continue doing so until the prices decrease, as we feel it's our responsibility to adapt to these changes. Well, I'd love to hear that. And remember, as far as prices, I can't predict that, because if a recession hits, sure, the prices go down. But we're talking about inflation. Inflation is the increase of prices. And so what people are upset about is the difference in what prices were in 2019 before the pandemic and then now, right? Because there's a lot of difference there. When it comes to insurance, that's every region is different. Florida is horrible. Insurance is horrible here because all the providers are pulling out because of hurricanes, things like that, right? So ours is just terrible. Now, as far as foods, the essentials, and all that stuff, I don't think Walmart, just out of the gracious of the heart, is going to, decrease prices for you. And so something has to happen to make actual prices come down. Okay, now if tariffs are enacted tomorrow, by the way, on Mexico, Canada, and China, if that it should be today, I'm sorry, as you're watching this, it'll be today, then prices are going to go up. We pay the tariffs, right? Because companies are going to turn around and absolutely raise prices. Don't mean it's going to be about 25% or 10% or whatever it is, but they ain't just going to eat those costs. Okay, you can bet money on that. So Canada, Mexico, and China are not going to pay for tariffs. Companies pay it, then they pass it on to us. Okay, so it might get worse. Plus, we have to look and see if they retaliate against us if that happens. Okay, let me know in the bottom if you actually think that's going to happen or not as far as the tariffs. I'm just curious. And last one here says, what do you mean by dark pools? I've got this question a long time in the past, so I'll just say it. Dark pool orders is a stock market order placed on private trading platforms called a dark pool, where buyers and sellers can execute large trades without publicly disclosing the price or volume of the trade, allowing more anonymous trading with minimal market impact. Essentially, it's a way to trade in large quantities of securities without alerting the wider market to your intentions, often used by institutional investors. So I hope that makes sense. It's just because, remember, they make large purchases. And if that happened, if each stock hit the open market like that, you see these huge spikes and drops and everything like that. So that's pretty much why they do it. And I think I showed you the other day, for the first time ever, like over half, 51% of trades or buys and sells are actually off market now, off exchange. So that's interesting. We'll see how that's going to play out. And I guess it's a long-term trend. So I guess we'll see even more. So anyway, I hope you guys got something out of it. Please hit that like, subscribe button if you did. Feel free to answer those questions. I'd love to hear your input on tariffs and everything else we just talked about. Think about signing for the membership. Less than a McDonald's combo, and that's everything you get with it. And I'll see you guys tomorrow to set up the week. It's going to be a fun one, guys. A lot of earnings and a lot of data. Have a good one.